Hello, my name is Jesse Colombo, and in today's presentation I'm going to discuss how silver price suppression and manipulation works and what it will take for silver to finally thrive. As you may know, silver has repeatedly tried to break above the $32 to $33 per ounce range over the past year, only to be aggressively slammed back down each time. I don't believe this price action is random, organic, or coincidental. On the contrary, I believe it is clear manipulation by bullion banks like JP Morgan and UBS, which are determined to suppress the price of silver on behalf of central banks like the US Federal Reserve in order to maintain confidence in paper currencies like the dollar. In the next few slides, I'll zoom in on the intraday time frame to give you a closer look at how these slams unfold. Here, you're looking at the 5-minute intraday chart of COMEX silver futures from Friday, February 14th, 2025. Early that morning, during the Asian and European trading sessions, silver surged by approximately $1 per ounce or 3%, reaching a high of $34.24 per ounce. Silver appeared ready to finally break through the $33 resistance level that had been held since May 2024, sparking excitement among investors. Then, around 9 a.m. New York time, once the US trading session had begun, a massive flood of paper silver in the form of futures contracts was dumped onto the market, deliberately driving the price back below the critical $33 level. Please note that the silver being dumped was paper silver, entirely unbacked by actual physical metal. This is how bullion banks artificially suppress the price of silver, keeping it well below where it should be based on the true supply and demand for physical silver. What's sad and infuriating is the fact that this pattern of manipulation has persisted almost daily for decades, consistently driving prices downward, never upward. Here's another egregious example of the manipulation slam pattern on the intraday silver futures chart from late October to early November. During this period, silver made a strong attempt to break out, reaching as high as $35 an ounce, only to be aggressively slammed lower. Nearly every morning between 8:30 a.m. and 11 a.m. Eastern Standard Time, heavy selling pressure in the US trading session forced the price back down. These manipulation slams almost exclusively occur in the morning and rarely at any other time in the trading day. There is no doubt in my mind that these are clear fingerprints of bullion banks deliberately suppressing the price of silver. This is anything but organic or natural market behavior. Interestingly, Gold Charts R Us, a leading provider of precious metals data, analyzed and averaged every silver futures trading session from 2007 to 2013. Their findings clearly revealed a consistent pattern: sharp price slams in the New York morning session, followed by recoveries in the afternoon and overnight as the Asian and European markets open. This pattern is precisely what you see in this chart. Unfortunately, this exact same phenomenon is occurring in 2025. Gold Charts R Us also provided statistical evidence through another model demonstrating how for literally decades, silver is consistently slammed during the New York morning trading sessions, only to recover later in the European and Asian sessions. The black line on this chart represents the New York intraday silver index, which tracks the theoretical price of silver if one were to buy at the New York Open, hold throughout the trading day, and sell at the New York close. Starting from a base of 100 in 1970, this index has been relentlessly eroded, plunging to just 8.19 by February 2025, a staggering decline of nearly 92%. In stark contrast, the New York Overnight Silver Index, which is the blue line on the chart, represents the theoretical price of silver if one were to buy at the New York close in the afternoon and sell at the New York Open the following morning. Starting from a base of 100 in 1970, this index has skyrocketed to over 20,000 by February 2025, an astonishing gain of 19,900%. Gold Charts R Us also included the standard price of silver, represented by the red line on the chart, as a baseline for comparison. Since 1970, it has risen a little more than 16-fold, significantly outperforming the New York intraday silver index, but falling far short of the explosive gains seen in the New York Overnight Silver Index. This is clear evidence that normal market forces are not at play here. Instead, it points to blatant downward manipulation. Unfortunately, this suppression discourages both existing silver investors and potential newcomers, which is precisely the intended goal. By keeping silver artificially low, the manipulators aim to suppress any asset that competes with the US dollar, which itself is no longer backed by anything. Another method bullion banks use to suppress silver prices, besides flooding the market with massive quantities of paper silver almost every day, is spoofing. This tactic involves placing large sell orders on the futures limit order book in order to create an artificial price ceiling and reinforcing resistance at that level. This method of manipulation isn't just theoretical. In 2023, two former precious metals traders at JP Morgan Chase & Co. were convicted of price manipulation and spoofing as part of a broader market rigging scheme, resulting in fines and prison sentences. Yet, despite these convictions, similar tactics are still being used in one form or another. As I've been explaining, one of the key factors keeping silver's price suppressed over the past year has been the heavy short selling of COMEX silver futures by swap dealers, primarily the trading desks of bullion banks such as JP Morgan and UBS. In the process, they amassed a massive net short position of 30,233 futures contracts, which is equivalent to 151 million ounces of silver, which is nearly 1/5 of the annual global silver production. This staggering figure highlights the immense downward pressure exerted on the silver market. What's even more astonishing is how much of this massive short position in silver futures is naked, meaning it isn't backed by physical silver. It's merely paper silver being dumped onto the market to suppress prices. However, once silver finally breaks out, it could trigger a wave of short covering, when traders who bet against an asset through short selling are forced to buy it back as prices rise in order to limit their losses. As the price climbs, these traders become increasingly desperate to close their positions, further fueling the rally. If the buying pressure is intense enough, it could even lead to a short squeeze, dramatically amplifying silver's upward momentum. Given the sheer size of their short position, bullion banks stand to lose approximately $151 million for every $1 increase in the price of silver, a setup for a major price surge. Now just imagine what will happen as silver climbs by $5, $10, $20, and beyond from this point. The risk of an explosive silver short squeeze is further amplified by the astonishing ratio of 378 ounces of paper silver, including ETFs, futures, and other derivatives, for every single ounce of physical silver. In a violent short squeeze, holders of paper silver could be forced to scramble for the extremely scarce physical silver to fulfill their contractual obligations. This would cause the price of paper silver products to collapse, while physical silver prices would skyrocket to jaw-dropping levels, potentially reaching several $100s per ounce. If you're enjoying this content so far, please consider subscribing to my best-selling newsletter that can be found in the description below. It only costs $15 a month and features detailed analyses of precious metals and comprehensive reports about global economic risks, including dangerous bubbles that are ready to burst at any moment. So what motivates bullion banks to suppress the price of silver? Well, they do it on behalf of central banks such as the Federal Reserve, which seek to maintain confidence in paper currencies like the US dollar. A soaring silver price signals weakness in fiat money, raising doubts about its strength and stability. By keeping silver artificially low, they help preserve the illusion of a strong dollar. You can see the motivation behind this when considering that the US money supply has surged by over 85,000% since 1920, drastically eroding the dollar's purchasing power. This decline, in turn, has driven up the cost of living over time, which is why a normal middle-class life is increasingly becoming out of reach for the majority of Americans. In contrast, while the paper dollar has lost its purchasing power, silver has retained its value, as I will demonstrate in the next slide. While the supply of dollars has surged and continues to expand, silver has consistently preserved its purchasing power. This compelling chart illustrates how the purchasing power of $1,000 in silver ounces has changed over time. In 1960, $1,000 could buy 1,087 ounces of silver, but today it purchases only 30.72 ounces, a staggering 97% decline in the dollar's purchasing power relative to silver. This means that the same amount of silver in 1960 could purchase roughly the same amount of goods and services then as it does today, while the dollar lost significant value. That's a powerful reason to consider storing wealth in physical silver. One key reason why I believe silver will soon break free comes down to basic economics 101, supply and demand. Over the past 5 years, silver demand has consistently exceeded supply, resulting in a persistent deficit as shown in the chart. In 2024 alone, the shortfall reached 182 million ounces, with an estimated additional 149 million ounces this year, and deficits are expected to continue for the foreseeable future. As a result, above-ground silver stocks are dwindling rapidly. While bullion banks can create unlimited amounts of paper silver to suppress prices, they can't manufacture the real physical silver that is crucial for a wide range of industries alongside growing investment demand. The persistent silver deficit stems from both dwindling supply and surging demand, a combination that in an unmanipulated market would naturally drive prices higher. That's why I see silver as a beach ball being held underwater. Pressure is building and it won't stay suppressed for much longer. On the supply side, global silver mine production has peaked and declined over the past decade as economically viable deposits become depleted, something the bullion banks have absolutely no control over. And as time goes on, this supply crunch is only likely to worsen. At the same time, demand for physical silver has skyrocketed across multiple sectors, with the biggest driver being the surge in solar panel manufacturing. As the world shifts away from fossil fuels toward renewable energy, this trend is only in its early stages. Silver demand for photovoltaic or solar panel applications alone has nearly tripled over the past 4 years, increasing by an astonishing 143.1 million ounces. With global efforts to expand clean energy accelerating, this demand is set to grow even further. One of the key reasons silver is set to soar upon breaking free of the manipulation is how remarkably cheap it is. For example, adjusting silver's price for inflation shows just how undervalued it is by historical standards. During the Hunt brothers' spike in 1980, silver reached an inflation-adjusted price of $196 an ounce. In the 2011 bull market, driven by quantitative easing, it hit $71 an ounce. Currently trading at just $32.69, silver has significant room to rise if it's to catch up with these previous inflation-adjusted peaks. Another way to assess whether silver is undervalued or overvalued is by comparing it to various money supply measures. This chart shows the ratio of silver's price to the US M2 money supply, providing insight into whether silver is keeping pace with, outpacing, or lagging behind money supply growth. If silver's price significantly outpaces money supply growth, the likelihood of a strong correction increases. Conversely, if silver lags behind money supply growth, it suggests a potential period of strength ahead. Since the mid-2010s, silver has slightly lagged behind M2 growth, which combined with the other factors discussed in this presentation, position it for a strong rally. The long-term gold to silver ratio chart clearly shows that silver is significantly undervalued relative to gold, suggesting that silver has substantial upside potential. As silver rises to close this gap, the ratio would decline. The current gold to silver ratio stands at 89, but if it were to revert to its historical average of 53 since 1915, without any increase in gold's price, silver would be valued at a solid $55 per ounce as compared to the current price of $32.65 an ounce. There are many indications that silver is on the verge of a powerful bull market, such as its breakout in April 2024 from a 2-decade-long triangle pattern. Even more exciting is the fact that silver's logarithmic chart, dating back to the 1960s, reveals a cup and handle chart pattern indicating the potential for silver to reach several $100s per ounce during this bull market. In order to confirm this particular scenario, silver needs to close decisively above the $50 resistance level. In the short term, it's encouraging to see COMEX silver futures finally break above the critical $33 level. Next, for further confirmation, I want to see a strong, high volume close above the $34 to $35 resistance zone, the same level that halted the late October rally in its tracks. Once silver clears both barriers, the path should be wide open for a powerful bull market. For this breakout to remain valid, however, silver must close and hold above both resistance zones, otherwise all bets are off. I closely monitor silver priced in euros because it provides valuable insights by stripping away the influence of US dollar fluctuations, offering a clearer view of silver's intrinsic strength. In euro terms, silver tends to respect key levels such as 30 euros, 31 euros, and 32 euros, forming well-defined areas of support and resistance. Recently, silver broke above the 30 euro level, a bullish signal establishing it as a new support. Next, a decisive close above the 32 euro level, the late October high, is necessary to signal that the next phase of the bull market has begun. That said, for the breakout to remain valid, silver must close and hold above both resistance zones. Otherwise, I would consider it invalidated. I also want to point out how gold struggled from 2020 to early 24 to break above the $2,000 to $2,100 resistance zone, which acted as a price ceiling for much of that period. Despite multiple attempts, gold was repeatedly pushed back down by the bullion banks that were working hard to suppress the price of gold as they currently are with silver. However, in March 2024, gold finally broke out, igniting the powerful bull market we see today. I see striking parallels with silver's $32 to $33 resistance zone over the past year, and believe that once silver manages to break free of the bullion bank's suppression and closes above this level, it will soar just as gold did. In conclusion, silver is among the most manipulated assets in the world, with its price frequently suppressed through orchestrated sell-offs. Bullion banks achieve this by flooding the market with massive amounts of paper silver, triggering sharp declines and distorting its true value. The relentless suppression of silver by bullion banks has made it one of the most undervalued assets, if not the most undervalued, on the planet. This presents a tremendous opportunity for patient silver stackers who recognize its true value. Silver is like a beach ball being forced underwater. Its suppressed price cannot be held down much longer, especially with gold soaring and physical silver demand outpacing supply for the 5th consecutive year. I believe a decisive technical breakout above silver's year-long price ceiling will ignite a powerful bull market, much like gold's surge over the past year. If you enjoyed this presentation, please hit the subscribe button below and like this video. Also consider subscribing to my newsletter that can be found in the link in the description below. Once again, I'm Jesse Colombo and thanks for watching.